And that's what we've been seeing around the world. But as you can see, even what's been happening in the US is very particular to that small group of borrowers, not everything in the US. To the extent that that small group of borrowers in the US is suffering some quite significant financial problems, doesn't necessarily mean that the rest of the world or New Zealand or anybody else has to follow suit. Okay. Do we run similar risks? I actually think we do. Like the US, we have consumers who had dived in to buy houses, potentially borrowed too much, interest rates have gone up sharply, and now are finding that they're having difficulties. Those financial difficulties are actually playing out in a different way than they are in the US. In the US, it's come through the housing market. We have seen it come here through finance companies. So I'm going to talk a little bit about why New Zealand is similar to the US and also why we're very different. In terms of the housing sector, I think we do potentially have a problem. We are going to see a slowdown, but not US style. The average borrower in New Zealand has a traditional mortgage. We don't have those very low teaser rates to tempt people in. We don't have a lot of low documentation loans. They're a very small part of the market. And one of the very basic things is the banks own those loans. So the banks are very careful about who they lend money to because they're not passing the buck on and passing the risk on to investors. It stays with the bank. Okay? Now, why I think potentially households here could become unstuck and are starting to become unstuck, what I have here is a graph that shows what percentage of our income goes aside just towards servicing our debt. So just towards interest costs on our debt. The red line is New Zealand, the black line is Australia, the pink line is the US, and the maroony coloured line is the UK. So the Americans thought they have a problem because the cost of them servicing their debt had risen because of high interest rates. Our debt servicing costs are among the highest in the world. Have our houses become overvalued? Potentially, yes, they have. A year ago in the US, I read an article in the Economist magazine, and they're saying we should be really worried because in America, house prices are now 4 times the average annual income. So it's a basic measure of affordability. How many years of income is worth one house? In New Zealand, it's above 7. So yes, we do potentially have a housing market that's gotten out of control. Does that mean a collapse is coming? Not necessarily, but I think we do need things to slow down because they have gotten out of control. We have in New Zealand an extremely low unemployment rate. This is the other thing about mortgages and defaults. We have an extremely low unemployment rate. If you become unstuck and find that you've stretched yourself too far, the average New Zealander is unlikely to bail on their mortgage. They will fight to the very end to hold on to their home. In the US, it's a little different actually. In the US, there are borrowers everywhere, lenders everywhere. If you bail on one, you can move and go find someone else who'll lend you money. Not that easy in New Zealand. If you default on your mortgage with the ASB, the National Bank isn't going to be that keen to lend you money. But you also have a very strong emotional attachment to your home. So say in the US, people do actually in America default on their mortgage as a matter of strategy. So if they find they borrow too much, their house has gone down in value, it's actually just easier to walk away. Like I said, here we're more likely to hold on. If you are going to bail on something, on your debt, which debt are you most likely to bail on? This is where the lesson comes in. Your washing machine, your car, your stereo, the furniture that you've bought. If you can stick it out, your house will appreciate over time. These other assets depreciate really quickly. It's not that hard walking away. You don't particularly have a very strong emotional attachment to your washing machine. I mean, personally, I love mine, but yeah. So you can see that it's actually quite different. And this is why we're seeing some of those risks play themselves out in terms of the finance company sector first and foremost. The problem with finance companies is that we have such a wide range of them, and as in the US, people didn't know quite how to invest in these products where they were investing in mortgages, because there's a lot of fancy things going on. These mortgages were being pulled together, put in a nice little bundle, given fancy names. People didn't understand them at all. With finance companies here, people don't understand them. They don't know what questions to ask. They don't know how to pick the good from the bad. And at the moment, we are seeing a bit of that panic reaction in terms of, I just want to take my money out. Not all of them are experiencing that, but I have heard of a few. So it's easier to get out. Going back to this bank versus finance company thing, people think putting your money in a finance company is like a term deposit with a bank. It's actually very, very different. It may look the same, $8.75 for 3 years or whatever, but it's not. Banks are very closely monitored by the Reserve Bank in New Zealand. They're regulated, highly regulated. They have credit ratings, good credit ratings, and those credit ratings are stable over time. Finance companies, most of them don't have a credit rating, a few of them do. Those credit ratings are not necessarily stable over time, and the risk attached to that credit rating is not stable over time. As you go down the credit rating scale, the risk of losing your money doesn't go up in incremental steps. As you go down the credit rating scale, the risk increase gets bigger and bigger and bigger. When times are really good, the risk can be low. The economy's strong, employment's really low, things are fine, people are repaying their debt, not a problem, the risk can be low. But as the economy deteriorates, if we do start having problems with our housing market, then the risk does go up. In other words, the risk is cyclical. Do keep that in mind. Some of the questions to ask, it does come back to diversification. How diversified is that company's lending on the other side? Has it got 10 borrowers at the other end? 100, 500, 1,000, 10,000, 20,000, 500,000? So how diversified is it across each borrower? How big is any single borrower? So is there one single, if two borrowers default, how big an impact is that going to have across? Is the money being invested in one project, say, for example, as we saw with the Heritage in Auckland, or many? Is it being lent in one sector or many sectors? But from an investor point of view, that diversification story goes one step further. Putting your money in more than one finance company doesn't necessarily imply diversification. Neither does putting all your money just in shares in New Zealand. Neither, for that matter, does just putting your money in New Zealand. In other words, if something unexpected, uncontrollable, that you haven't planned for goes wrong, is it going to impact on all my investments, just one of them, or just a couple of them? We have done some extensive research into finance companies, not ourselves. We didn't even have the expertise to do it because it's not a simple story. We actually contracted out and paid a lot of money to contract it out. So the number one story is do your homework, do ask the right questions, and if you just don't know, then get someone to do it for you.